We have crossed a line that markets rarely cross. For years, many analysts argued that the silver market was distorted, tightly controlled, and held in place by artificial pressure. The idea was always the same. If that pressure ever failed, the move would not be gradual. It would be violent. What we are seeing now strongly suggests that this is exactly the phase we have entered. Based on end-of-week electronic trading data, silver is trading around the high 70s, roughly a 10% move in a single session. Moves of this magnitude do not occur in calm, healthy markets. In commodities, a double-digit daily move is not a rally in the traditional sense. It is a stress signal. It usually appears when something inside the system is being forcibly unwound. Under normal conditions, prices move through negotiation. Buyers and sellers meet, liquidity absorbs demand, and the chart breathes. In a forced liquidation, that process disappears. Positions are closed not because someone wants to trade, but because they must. Algorithms take control. The only instruction is to exit, regardless of price. When that happens during a period of thin liquidity, price does not climb step by step. It jumps, it gaps, it appears to teleport. That vertical behavior on the chart is not excitement. It is absence of sellers. It suggests that a large participant, likely operating on the short side, was compelled to buy into an empty order book. When that happens, price becomes discovery, not negotiation. This is why a 10% move matters. It signals that what was once considered a theoretical risk is now moving into systemic territory. Historically, when silver behaves this way, it is not reacting to a single headline. It is responding to pressure that has been building quietly over time. To understand the context, we have to look at gold. Gold is not just another asset, it is the reference point. With gold trading near the mid-$4,000 range, the message is not subtle. It suggests a rapid loss of confidence in the currency used to price it. Silver does not move independently of that signal. It follows it, often with leverage. When gold establishes a new regime, silver attempts to close the valuation gap. Historically, that gap has been measured through ratios, and by most long-term comparisons, silver remains far below where it would trade if pricing were fully normalized. That does not guarantee immediate upside, but it explains why algorithms and institutions begin to rotate capital aggressively when gold breaks higher. What we are likely witnessing is not simple speculation. It is repricing. Repricing driven by the perception that paper claims are becoming less reliable than physical ownership. That perception alone is enough to drain liquidity from futures markets and push participants toward immediate delivery. The timing matters as well. This move occurred during one of the thinnest liquidity windows of the year. When markets are lightly staffed and participation is low, any forced action is amplified. That does not create the problem, but it exposes it. Now consider the psychological layer. Markets may be closed over the weekend, but risk does not pause. News, rumors, and internal assessments continue. Participants who hold leveraged or paper exposure are left with uncertainty, while those holding physical assets face no margin call and no counterparty clock. This divergence is critical. When confidence erodes, capital does not ask for confirmation. It moves preemptively. That is why reports of tight physical availability, delayed pricing, and inventory withdrawals tend to appear during moments like this. Dealers slow down not because demand vanishes, but because volatility makes pricing dangerous. When the official price lags the street price, it signals stress in the currency mechanism itself. Goods begin to trade outside the screen. That is how monetary transitions start, not with announcements, but with disconnects. Looking ahead to the next open, the focus will not be on headlines, but on mechanics. Futures exchanges operate with circuit limits designed for orderly markets. When price approaches those limits too quickly, trading halts. To outside observers, this looks like chaos. Internally, it is a sign that demand is overwhelming the system's ability to process it. For short participants, this is the most dangerous environment possible. In a halted market, risk cannot be reduced. It can only accumulate. History shows that once this dynamic begins, volatility expands rather than contracts. It is important to understand that none of this requires panic to continue. It only requires absence of trust. When participants begin to question settlement, counterparties, or availability, behavior changes immediately. Leverage is avoided, ownership is favored, speed replaces price sensitivity. This is also where institutional behavior matters. Large funds do not wait for perfect entries. They chase confirmation. A sharp move attracts more capital, not less, because performance metrics reward momentum. That creates a feedback loop in already strained markets. At the same time, pullbacks, if they occur, should be expected. Vertical markets are turbulent by nature. Sharp retracements do not invalidate the move, they test conviction. In an environment where supply is constrained, dips tend to attract stronger hands rather than end trends. The larger risk now is not volatility, it is misinterpretation. Treating this as a normal rally leads to normal strategies, and normal strategies fail in abnormal conditions. This is not a market built for leverage. It is a market built for patience and ownership. As the next sessions unfold, attention will shift beyond silver itself. Stress in one corner of the system rarely remains isolated. Funding markets, interbank confidence, and policy response all become relevant when commodities reprice this aggressively. What matters most right now is perspective. This is not a random spike. It is the visible result of pressure that has been accumulating quietly for years. Price is simply catching up to reality. The suppression narrative was never about timing. It was about inevitability. And when inevitability finally asserts itself, it does not arrive gently.
Hello, my dear friend. Welcome back to my another video and my channel. Thank you so much. So, friend, we have crossed a line that markets rarely cross for a years. Money analysts agreed that the silver market was distorted, tightly controlled, and held in place by artificial pressure. The idea was always the same. If that pressure ever filled, the move would not be gradual. It would be violent. What we are seeing now strongly suggests that this is exactly the pace we have entered based on end of week. Okay, entered based on the of week electronic trading data. Silver is a trading around the highest 70, probably a 10% move in a single session. Moves of this magnitude do not occur in calm healthy markets. In so friends, thanks for watching and subscribe my channel and like this video. um, Subscribe for more videos. Thank you so much.